Welcome back to Thimbleberry U. I am John Jagay, joined again by Amy Walls from Thimbleberry Financial. Great to be back with you, Amy.
Jag, it's always good to be talking with you.
So we're talking about Donald Trump's tax returns today. They were released a few weeks back by the New York Times, and they were quite the headlines for quite some time. And I know you generally like to stay clear of politics, but what is the reason for wanting to cover this particular topic today?
Yeah, there's a lot of important financial information related to taxes that isn't always fully understood. And today I just want to break down the difference between things like income, net worth, profit and loss, as well as understand depreciation, talk about tax losses, and a few other things. It's a lot to unpack. The backstory you alluded to, and that a lot of folks already know, is that a couple of weeks ago, the New York Times released that deep dive into a bunch of President Trump's corporate tax returns. Those returns had previously been the subject of a court battle. The president didn't want them released, and he's not the one who actually released them. They were obtained by the New York Times from an unnamed source who is also said to have legal reason to possess them.
So we're talking politics today, or?
Yeah, I'm glad you brought that up, Jag. No, we are not. And I want to be clear that the work I do and the work my firm does, financial planning and wealth management, is nonpartisan. I'm going to do my best not to make this a political discussion. But from a financial planning perspective, most of the information that was revealed in the Trump tax returns is counter to what Trump has said about his business acumen. There are also terms we regularly use in financial planning that are often misunderstood.
Sounds like a plan, Amy. So let's start with net worth. Explain that to me as an outsider here who doesn't quite understand that term, and why that matters for the sake of this discussion.
Absolutely. So I'm actually going to turn to Investopedia here. Net worth is the value the assets a person or corporation owns minus the liabilities they own. Net worth is calculated by subtracting all liabilities from assets. An asset is anything owned and that has monetary value, while liabilities are obligations that deplete resources. Positive net worth means that assets exceed liabilities, while negative net worth results when liabilities exceed assets.
Makes sense.
And taking a break from the definition that they have, I really think of that as kind of two columns, the things that are positive in one column, and then on the other side, it's the things that are negative.
Sure.
So going back to their definition, positive and increasing net worth indicates good financial health, while decreasing net worth is cause for concern as it might signal a decrease in assets relative to liabilities. The best way to improve net worth is to either reduce liabilities while assets stay constant or rise, or increase assets while liabilities either stay constant or fall. So if we were to look at an example of an individual, we can assume someone owns the following things: a $600,000 home. They have $500,000 in their 401k. Their cars are worth $30,000, and they have $200,000 in an investment account. So that's a total of $1,330,000.
So that makes them a millionaire, right?
Well, you would think so. But what I didn't mention, because I was only in the first column, is that they owe $400,000 on the mortgage and $20,000 on the cars. So we have to subtract $420,000 from the $1,330,000, which means that their net worth is $910,000. It's a good net worth, but it is not a millionaire status.
Assets minus liabilities. Got it. Okay. So how does this relate to the Trump tax returns?
Yeah, well, first, Trump garnered support from millions of Americans who thought it would be better to have a successful businessman and billionaire that didn't need the salary as president that a career politician does. So his own tax returns show his net worth at $4.2 million, not billion, millions, M, not B.
Got it.
So I'd actually say, for a really good summary, you can read an article called 10 Quick Takeaways from the New York Times bombshell article on Trump tax returns. That was posted on the conservative-leaning website Just Security.
We'll link to that in the show notes as well.
Awesome.
All right, so $4.2 million isn't shabby, but it's not anywhere what he himself had said he had in wealth.
Correct, Jag. That's so true. And the other thing we have to point out is just because you have a lot of personal or business income, it doesn't mean it's not going right back out the door in expenses.
That's a fair point. So there's been a lot of talk about depreciation to explain those business losses the president has had. Can you give me a basic definition on what depreciation is?
Yeah, so let's go back to Investopedia again for a definition. Depreciation is an accounting method of allocating the cost of a tangible or physical asset over its useful life or life expectancy. Depreciation represents how much of an asset's value has been used up. Depreciating assets help companies earn revenue from an asset while expensing a portion of its cost each year the asset is in use. If not taken into account, it can greatly affect profits. Businesses can depreciate long-term assets for both tax and accounting purposes. For example, companies can take a tax deduction for the cost of the asset, meaning it reduces taxable income. However, the Internal Revenue Service states that when depreciating assets, companies must spread the cost out over time. The IRS also has rules for when companies can take a deduction.
Okay, that makes sense. So can you give me an example of what depreciation would be in our world?
Yeah, so Jag, you and I are both business owners. So we can depreciate large equipment expenses like recording equipment that we're using right now or computers. Also, if an individual owns a home and doesn't sell that home when they move to a new home, but they rent it out, then they can depreciate the asset of the home that is now being rented out for rental income.
Okay.
So basically, this depreciation is paper losses that are used to offset the income. So in the case of the rental income they get from the house. And in many cases, someone may be cash flow positive, but show a loss on paper.
So they wouldn't pay tax on that income.
Correct. And until the mortgage is paid off, that might be the case. But once the mortgage is paid off and there's not the expense of interest on the mortgage, they will likely have to pay tax.
So that's what President Trump did? He took out more loans and therefore doesn't show an income?
Possibly. We know that he's not afraid of debt. There are 6 bankruptcies in his history to prove that is a fact. It's possible that he kept leveraging properties, which means borrowing more money against them to spend it in other places. Those loans had interest, that leverage or loans, those had interest, and that interest coupled with the legitimate depreciation on the asset causes him to show a loss. That would allow him to not pay taxes on any of the income.
So is that how he was able to get away with paying only $750 in tax in some years?
That might be exactly the reason. I can't say for sure. There is an ongoing dispute between Trump and the IRS for $72.5 million.
Okay.
Related to lost deductions for his failed developments in Atlantic City that started before his election and continues today. If all or part of that loss were to be disallowed, it could mean millions due in taxes and penalties by Trump to the IRS.
So if he only has the $4 million net worth, as you mentioned earlier, where would he get that $72.5 million?
Well, that's a great question. And I think one of the issues that came up as a result of these tax returns, and I don't have an answer to that. The bigger problem is that he has over $300 million of debt that is coming due in the next 5 years.
That is a lot of money, but can you explain why that would be a problem?
Yeah, so let me address this in kind of a smaller, maybe more personal way.
Okay.
So I'm a financial advisor. That means I do financial planning and wealth management. To do that work, I have a securities license, or actually some licenses, that require a background check and clean financial history. So if I were to file bankruptcy or have financial trouble in other ways, such as a large amount of debt that I have no way of paying, I would be in jeopardy of losing my license.
Got it.
Okay. And certainly if my brokerage check profile at FINRA.org showed that I filed bankruptcy 6 times, which I haven't, people looking to hire me as their financial planner should absolutely run from me.
Fair point. Okay.
Right? I'm not who I say I am. I'm not doing what I said I do. So my ability to do my job in giving oversight and advice is believed to be impacted enough by these types of financial issues that my licenses could be revoked. I'm not president of the United States. Right? So in my background check, they're saying, we're willing to revoke this because you don't have this legitimacy. They're saying I could be under pressure to not do the right thing for clients. So when we relate that to the president of the United States, The big question becomes, how will a president who has a lot more influence and control than a financial advisor be impacted by having that amount of debt, and how the pressure from that debt will impact their decision making?
Sure.
So if the question is, will I give advice to make money and bail myself out? If that's a question that comes into play based on my financial status, then we can say the question for the president is, will they make a decision on behalf of the American people or for the benefit of a foreign power that primarily keeps loans from being called or gives himself the ability to pay them in the future?
Wow, we have talked about a lot today, Amy, and I think that assessment kind of helps me understand some of the stories we've seen over the last few weeks about the tax story with Donald Trump, so thank you for breaking that down for us. Of course, we're going to link to all the resources we covered today in the show notes for this episode. And perhaps not Donald Trump, but if anybody listening wants to get financial advice and talk to you about their financial future, what are the best ways to reach you?
And first of all, just to be clear, I don't have 6 bankruptcies in my history.
Worth repeating, yep.
You can reach us at the office at 503-610-6510, or just go to our website, thimbleberryfinancial.com.
Excellent. Good stuff, Amy. We'll talk again soon.
Sounds great, Jag. Thanks.
Registered representative, securities offered through Cambridge Investment Research, Inc., a broker-dealer, member FINRA SIPC. Investment advisor representative, Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Thimbleberry Financial are not affiliated.